Sales job, snow job. You want to be in Who's Who? Yeah, hey, $14.95.
Okay, here we go. Welcome. You're listening to the best of investing on Talk 910. This is the show where we present valuable information about real estate, the financial markets, and other economic business of the day. And for those of you listening for the first time, here's our format. A few guys sitting around a bar having drinks, without the drinks, talking business with you, the audience listening in. I'm your host, Edward Brown, and I'm pleased to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing private lender, and Lou Batmale of LPL Financial, our financial advisor. Our phone number is 888-912-1190. Write that number down, 888-912-1190, because you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. The vacations are free. They only request a $75 cleaning fee to cover housekeeping expenses. You can reach them at lighthouseforfun.com. Call them also at 916-777-5511. And today's trivia theme is the cartoon The Simpsons.
Nice.
Nice, huh? Okay, now, Lou, you've got a lot of good information for us, so take it away.
Well, it's December. I hate to tell everybody, but it's the silly season. We're all winding down, and right now is probably one of the best times to start your year-end and future year plan when it comes to financial planning. But what you do in the next couple of weeks can have a tremendous impact on your taxes. And
I knew it. You're going to talk about tax planning.
tax planning is a big part of financial planning, and
it's important. We got to talk about it.
Mark, I will tease you a little bit. At the end, we'll talk about the new tax system, net interest income tax, which I don't know if you know about. That's the third tax system on top of W-2 income or 1040, AMT taxes, and now we have the net interest income tax. Some are calling the Obamacare tax on the sale of homes.
Yes.
So they're coming after that one pretty good.
Yeah.
We'll maybe set to the end, tease a little bit. But so the real thing here is, do you have a plan in place? Have you been saving money throughout the year? You need to do a head check right now and say, what have I been doing? What am I going to do into next year? Because people, financially have been doing better. So review your goals, check your plan, and if you had one in years past, dig it out and take a look. And we've had some bad economic years, but things are starting to improve. And now you got to start thinking ahead a little bit behind as well. What I mean by behind, I mean behind in this year. We have a couple weeks left. So look at your income. Are you going to get a bonus? Okay, if you're getting a bonus, are you going to defer that to your 401k plan? Okay, everyone has a little partner out there that we work with called FICA and FUTA. They appear on your paycheck. Ever see them?
No, not FUTA.
It's
Medicare.
Medicare. Well, yeah.
Because FUTA is federal unemployment.
Right.
It's made by the employer.
Yes,
but
exactly.
I know what you mean.
Yeah,
but basically, it's Social Security.
Our paycheck friends.
Yeah.
So you can defer our paycheck friends.
Well, what most people do, they got their first paycheck. Who's FICA?
Yeah, exactly.
And how did he work for me? Go ahead. All right.
Well, the idea is that if you put money or your bonus into these plans, okay, into the 401k plan, you don't pay tax. You don't pay those taxes.
So not only do you avoid income tax,
correct,
but you also get out of paying FICA and Medicare tax by money that goes into your 401k.
Right.
That's a pretty good deal.
And if you're self-employed, think about doing a SEP IRA. Now the difference there, or a personal IRA you can do as well. The big difference here is a 401k has to be funded by year end.
Yeah.
So we have only a couple of payrolls left. You want to work with your payroll department, maybe slip a bottle of booze or something like that. So, look, on the last payroll check, I want to do X, Y, or Z. You can actually, in most plans, defer all of your income in your last paycheck.
Yeah.
If you have enough savings, you made it through Christmas, why not put some money away?
Do you know what the limitations are? Like
$17,500. If you're over 50, it's $22,500.
Is it a percentage at all? Or is it
No,
it's
it's flat numbers, yeah.
Okay, and then also what I like though is that if you have employers who do any kind of matching, that's free money.
It's free money, yeah. People are starting to ramp it up again. It's been a slow process, but I control some plans. I have some of their clients, and we're starting to see maybe a 3%, 4% match. So take advantage of that. So
and at this time of the year, we're in December. The money we're getting now, it's all the marginal rate, meaning we're paying our top tax rate on that money. So if you don't need it,
yeah, absolutely, yeah. And then if you're doing more planning and you're employed on a personal level, 1099, think about a SEP IRA. You don't have to fund that till you actually pay your taxes, which could be April 15th or next October. If you're a corporation, maybe I should do profit sharing. Again, you have to fund that till you file your taxes. So start thinking ahead right now. If I have extra money around,
if you don't have a corporate plan though, you do have to set it up by the end of the year. You just don't have to fund it.
That's why you need to call a professional in right away.
There you go.
And then other people. I actually am working on 2 plans right now, year-end plans, and people
Wow.
say I want it this year going into next year. So it's really important that people start thinking ahead. And also the other big thing is capital gains rates have changed. And everyone's made a lot of money in the investment markets this year, and people made a lot of money in real estate. So start thinking about what's my capital gains impact. So
what are the rates and tiers right now?
well, this is the tough part, okay, is that everyone's income is going to affect their capital gains rate like it hasn't in years past. So we're used to the 15 and the 9.6 here in the state of California. That's going to 20 for most people at 9.6. So
Wait, for California?
well, it's a federal rule. Everyone thinks 24 in California. Now you got to start thinking 29.6
The 20
Yeah.
plus the 9.6.
plus 9.6. Yeah. So everyone was like, oh, it's easy. It was 25% before almost.
Oh,
Now
yeah.
it's 30%. So you got to start thinking ahead. And what I tell people is there are some investments that haven't done well. You can sell those investments by the end of the year, and they have losses in them. That's called the capital loss, and that can go against a capital gain. Also, any capital loss up to $3,000 can be deferred against your income in the next year. But more importantly, you need to bank these gains whenever they occur. So maybe you invested in something that didn't work. Hey, sell it, bank that loss, so it gets future gains in future years. It carries forward. But also you can go against gains you have this year. Some people have them in real estate. Some people have them in their investments or their investment portfolios.
And you have some information about real estate too, don't you? But
All right, so this is the big thing that everyone's called this the Obamacare tax or the Obamacare tax. It's a 3.6% tax increase. It's the net interest income tax. So think of it this way: we have 3 tax systems now in place, like I just mentioned.
Yeah.
We have the ordinary income tax that we're all used to. We have AMT taxes, which has never been indexed for inflation, right?
Right.
So everyone's fallen into that AMT limit. Even if I have people who are single, they make very little money that pay AMT tax.
and it used to be AMT was structured originally for people doing tax shelters.
Right,
Now
super wealthy.
everybody's gonna do
Yeah,
that.
I mean, there's all offshore and all that stuff. But they're not removing it because it's easy tax for them
Yeah.
because no one really knows about it unless you're making money.
Yeah.
Now we have the net investment income tax. Now this is on a single person over 200,000 married, probably jointly is 250. So it's the adjusted gross income tax excluding foreign earned income, includes among other things wages, compensation, distributions from non-qualified deferred compensation, alimony, taxable Social Security income. So if your income's over these thresholds, you can be back up to that Bill Clinton tax level of 39.6
Ouch.
with an NII tax, we call it. And that is a separate system, separate calculation. Call your tax planner now because there are many offsets to this tax. You have to make sure you're not close to that threshold, and people should be nervous because this is going to surprise everyone saying, you know, I talked to some accountants already. They're like, I can't call my clients, so you're going to pay another 3% on your money because they're going to go crazy. And
And
that's
it's
out
on
of nowhere.
It's on the net
On
interest
And net interest investment income.
or investment income.
Net interest investment income. That's what's on.
Is it strictly on interest?
Yes.
So
This is
if
not
you sell-
passive activities.
What about selling real estate?
Selling real estate's right in there,
Right,
right in the
okay.
wheelhouse. So some people said if you sell your real estate, you might pay the Medicare tax or medical tax for Obamacare, which can be true in some cases. I'd say it's more indicative in California than it is in other places because people can make $500,000 on a home in California.
But it's based on your modified adjusted gross income. There's probably calculations.
There's a
on that.
calculation in there, but it's very complicated. And this is a third tax system. We already have 2. This is a third one. So imagine when you do when your accountant does your taxes, they hit enter on their computer.
Yeah.
It does 2 calculations now. Now it's going to do 3. And some people does not know this is there.
Amazing.
So
Probably gonna do 4. Okay, we're gonna
Yeah.
cut to a very quick commercial break. Again, the theme is the cartoon The Simpsons. Lou, this one we're gonna see if you know this one. Are you a Simpsons follower?
Yeah, back in the 90s.
90s, yeah. Okay.
It's been on a while.
What is the name of Homer's neighbor who usually says, "Hi diddly doo"? The first 3 callers with the correct answer win a free 3-day 2-night stay at the Lighthouse Resort. I see a squinting of the eyes there, not sure. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. What is the name of Homer Simpson we're talking about? His neighbor who usually says, "Hi diddly doo."
I got to log in real quick.
Yeah. 888-912-1190. Make sure to include your name and your email address. Speak slowly. Spell out your email 1 letter at a time. Don't touch that dial. The Best of Investing will be right back.
I don't have a clue.
You don't know
It's not
it?
Flanders. It's
Yes.
Flanders.
It's
Flanders? Okay.
Yep.
I'm getting that.
Then you're good. Yeah.
Isn't Flanders left-handed?
I don't know. I don't remember.
So,
Is he
Flanders
left-handed?
pretty much every
Am I
bit of it
left-handed?
to
Yeah, but he's not
exactly.
he's religious. He's
What about there's one real wealthy guy. He's giving most of his money away. He has cancer. The Simpsons creator. You guys read that story? Really interesting. One of the creators is terminally ill, and he's giving away
Matt Kroenig or
a
something?
ton. I forget which one it is, but it is a ton of money,
Wow.
like hundreds of millions. So I need this back, but this is your little reference guide for who's going to pay what tax. I went to this speech last week on this. Is scary.
It's a horror film.
Well, you can actually use non-qualified deferred compensation to offset that, but you have some executives that just fit right in there. There's not much
So
they
you
can do.
hold on my income to next
Well,
year.
that plus stock options, right, which are included in it.
See, and I
So-
sold a piece of property this year, but I've got some net operating loss carry forward, so my
Right.
AGI will be low enough.
But I
Praise
mean,
the Lord.
if you did know that,
Yeah.
that's the problem. Because this is all everyone's gonna hit enter in the computers next year and go, what?
I think the idea is just keep losing money, then you have to worry about taxes.
It's hard in Mark's business.
yeah, unfortunately.
Okay. Was there an article you wanted to touch on? Or,
Yeah.
Okay, then we'll kind of go back and
Yeah,
forth.
we can go back and forth. Yeah.
I'm not ready yet.
You're not ready. You're always ready. Holy smokes, Batman.
Okay, I'm on.
Ready?
Ready, Teddy. Let her have it, Captain.
Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hunt and Lou Batmale. When we got to the first commercial break, we asked this trivia question. Again, the theme is the cartoon The Simpsons. What is the name of Homer's neighbor who usually says, "How did you do?"
Is that Flanders?
That is Ned Flanders. Very good. Okay, Mark, you've got a couple articles you want to share with us.
Well, this one I pulled off the Wall Street Journal, and I absolutely can't believe this because listeners to the show know that we have pounded on the Dodd-Frank bill that was passed over 2 years ago now because of the resultant flow of regulations. In fact, starting in January, yet another layer of regulations are being added on, piled on, I should say, to the mortgage lending industry. And my company is Pacific Private Lending. We make privately funded real estate loans, and it used to be that our industry was not regulated for the most part, and now through this gillnet approach that the regulators have just been keying off this legislation, they're just pulling in all these outside industries that really were not part of, nor responsible for, nor really in the same room with the companies that caused the mortgage meltdown and the whole subprime mess. And so none other than Barney Frank himself, and it says here,
Dodd-Frank.
of Dodd-Frank, retired House Democrat Barney Frank is the last person on the planet you'd expect to criticize the implementation of the 2010 law that bears his name. But there he was at a recent event hosted by this trade group suggesting that regulators ought to focus on the banks instead of some of these other companies that and industries that they are going after. So he was quoted as saying that they're overloading the circuits, and that's not a good idea. And that his intent was to regulate the institutions that clearly needed to be covered, which were the large banks, and not some of these other industries that they're going after. So even the man himself, the man whose name we've taken in vain many times on this show, Frankendodd, and so I just, my head wants to explode when I think about this. It just goes to show you that these people don't know at Congress at the highest level that are responsible for regulating our industry. They don't know what they're doing. In fact, at the end of this article, it talks about, it pulls a quote in from Nancy Pelosi. Nancy Pelosi famously said that Congress had to pass Obamacare to find out what's in it.
Love that.
Wow.
And so, and that's it's related to this because that in many ways is exactly what happened with the Dodd-Frank regulations. They had to pass it, but nobody knew what was in it. No one really read the 2,500 pages of law and text and gobbledygook that was in there, and now you've got these non-elected government officials, which make up, 99% of the government is these non-elected officials at the GSA and elsewhere that are sitting there doing nothing but trying to figure out how to implement via regulation the intent of whatever the intent was of the law here.
Wait, are you telling me that you don't like the policy of first just passing a law and then just figuring out what's in it? I don't know, that sounds like pretty good policy to me.
And not only that, then coming up with layers and layers and layers of regulation that, in theory, will follow and cover the intent of the law. And so it's making law after the fact here. And I just find it interesting that Barney Frank really meant to just put a damper on the banks, the large banks, so that we wouldn't have another subprime meltdown, which almost took the government and the whole economy with it.
Yeah.
And yet now, industries like, our own private money loan origination, where we make loans to real estate investors who are only trying to do good in the economy by buying, fixing, and flipping distressed property. But oh no, now we're regulated up the yin yang too, thanks to Dodd-Frank. And so it's just crazy. So anyway.
This is not going to end, and unfortunately, but most investment companies I work with now are actually hiring political consultants to tell them where the laws are going and how things are going to work and what they're going to be at the end and what the political climate's going to be from year to year. So this year they're saying, oh, this is a clean year because it's an election year, right? So 2014 is election year.
Mm-hmm.
During the midterms, they're sitting there going, well, look, no one's going to upset the apple cart this year. You're not going to have any debt ceiling debate. You're not going to have any really problems going into next year because they don't want to lose their jobs. If they have another standoff like they had at the end of last year over the Health Care Act and all these tax laws, it'll be over for those politicians or their parties. So
yeah, and Lou, you just talked about in the last segment how we've got two new or a new set of taxation that's coming in that affects real estate investors in two ways. One is through the interest income for people who, in my line of work, like to participate in high yield, high interest paying notes, and also if you're a real estate investor or anybody who owns real estate, which is a large segment of a lot of people, a large segment of the population. If you sell real estate now, you're looking at possibly this additional tax. That's on top of the fact that beginning January 10th, you've got the new qualified mortgage regulations going in. There's a lot of things happening in 14 that are not going to stimulate the real estate market, that are actually going to dampen the real estate market. And it's not like the real estate market is on fire right now. I mean, some people might
it's hovering. It's doing okay.
It's really
It's doing okay in pockets, but everyone's, and we need housing makes up, 25% of GDP?
Yeah.
We need housing to make the economy go. It's a key ingredient.
Right, what we need is new housing starts. We need the construction industry for new home construction to take off. That's what needs to take off like wildfire, and it hasn't happened yet. And now we've got, a slew of new regulation and taxation coming next year that is not going to stimulate the construction industry and the real estate market. So I'm not saying that real estate won't go up in value in 2014, because again, in a lot of pockets it will, mostly because of supply and demand. There's not enough new supply, therefore, but yet there's demand there, particularly in the Bay Area where you got people making a lot of money at these .com companies, and so it's going to push up housing prices. But that's really affecting people only at the very top. But the vast majority of people who would rely on the economic growth stimulation from a strong construction market, that's
not there yet.
It's not there yet, and I just don't see how this is going to help.
Raising interest rates not going to help either.
Yeah, no, that's not going to help. So, for those reasons, so here we got taxation, we've got new regulations on mortgage lending. I think that there's a possibility that we're going to see stagnation in real estate and possibly a drag on the economy, which only means that interest rates aren't likely to go up. So if you're a saver and you're waiting for your CD rates to go up, that's not likely to happen in the next couple of years. The Fed might find themselves forced to, keep their foot on the pedal with quantitative easing. I mean, there's just a lot of stuff a lot of implications here that.
To your point, to back it up, most analysts are saying right now that the Fed funds rate, so we have this quantitative easing issue where that's money coming in the economy. They might try and taper that or bring those down in a very slow basis over the period of the year. But really what's going to happen is the Fed fund rates are not going to go up to like 2016. So that's going to be around 25 basis points, which will artificially also keep rates low during during this whole period, which is again going to affect savers. Where are you going to find yield in that environment? Remember too, there were bonds that were sold for 7% back in 2007, 2006, 2005. Those start coming off after 10 years.
Yeah.
They're retired. Then where do people go? And all the new debt's 2%. Who wants to invest in that stuff? Insurance companies use that as a part of their portfolios. They're really having problems right now, saying, where am I going to find my yield to live up to the expectations I have on income in the future? This is really a problem.
Yeah, because a lot of those insurance policies, people
Right.
were
They write on
get a certain income from that.
exactly.
So while the low mortgage rates are good, for a facet for the real estate industry, and it's not always good. There's always two sides to the coin. But when you figure that we've got a baby boomer age, we're all starting to get older and into retirement. We're supposed to be moving into more conservative investments like stocks and like bonds and CDs and those types of products that are not paying anything in terms of interest. And so we've got an aging population that, for the most part, I include myself in that, and most of us are really not on track to retire successfully at this point. And so, you're looking at low interest rates into 2016. Again, I have a solution for that.
Yeah, and so does Lou. In fact, we got some very good emails for both of you that we are going to share in the next segment, because that's what the listeners hang on their chair going, well, what am I to do?
That's why we're the best of investing.
That's right, exactly.
Talk about the solution to that problem of continuing low savings rates as far as the eye can see.
Okay, here is the second commercial break trivia question. And again, the theme is the cartoon The Simpsons. What is the name of the clown on The Simpsons? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com, and you have to do it in the voice. Okay, call 888. You have to get a frog in your throat. 888-912-1190. That's 888-912-1190 to answer this question. What is the name of the clown on The Simpsons? I'm guessing there's a lot of kids watching the show.
I think the clown in Living Color. That clown was better.
I'm trying to remember that one.
Homie, was it Homie the clown?
I don't remember.
Yeah.
Okay.
Homie, yes.
Call 888-912-1190. Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial. The best of investing will be right back.
Does Kelsey Grammer do the clown, or is that
No, I don't think so.
no? Who does it? Who's the voice of the clown?
I'm not sure.
Yeah, I don't know either.
He's looking it up.
No, I'm
No.
not.
Who is it? I don't know who it is.
The voice of Christ.
Krusty the Clown, right?
Is it someone we should know?
I don't know.
I know at one point Kelsey Grammer had a big one of those. There's been a lot of people on there, but was it 24 years has been on or something?
Is that right?
Yeah.
It's funny. I was going to say there's a bunch of kids listening to the show who've been, but it's like, that's more of an adult type shit.
Exactly.
It's like Family Guy, Mark's favorite.
Family Guy. All right, so let's see if I have internet service here.
If you have Verizon, you should.
Google.
Verizon's big in Brent, huh?
Yeah.
Yeah,
Yeah.
people who have Verizon never complain. I have Sprint.
I think I heard Sprint worked really well on Las Colinas in Santa Fe, but other than that, just want to check one thing. Mirka sent me something on Gutierrez. Thank you.
Dan Castaneda. Castellaneta.
Oh, he's
yeah.
the voice of Homer too, isn't he? Or no? He does a few voices.
No, but Yeardley Smith does Bart.
Okay.
So Mirka says thank you. She got something from
Yeah,
Jamie.
we're ready to go. We're
All
confirmed to release to record tomorrow. We did a loan in 3 business days, because I got the call Tuesday morning and it was funded today. So
Was it on a piece of property?
on a owner-occupied primary residence purchase, we did a bridge loan in 72 hours
Wow.
to save this person from losing the home. They fell out of bank financing last minute because of glitch of their credit. Because banks often repoll right before they're going to fund. And oftentimes it doesn't happen all the time, but it happens often enough to where I get 2 or 3 calls a month for, hey, I got a desperate situation, I got to close
That's
in a week.
crazy.
Can you perform?
You guys ready?
Yep.
Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Lou Lou Batmale. When we cut to the second commercial break, we ask this Simpsons trivia question. What is the name of the clown on The Simpsons?
That'd be Krusty.
Very good. That would be Krusty the Clown. Okay, Mark. Now we'll go from the humor to the serious now.
Yes.
Okay, so here's an email we got from you, and it's kind of interesting because it kind of follows what we were just talking about. How does your underwriting guidelines compare to a bank's? It's a good question.
So when the listener says yours, what they mean is how do private money loan underwriting guidelines differ from a bank? So my company is Pacific Private Money. We're based in Marin County. We make loans primarily to real estate investors all over California. The classic loan that we make, the kind of the bread and butter business that we have is making loans to people who buy, remodel, and then resell, also called buy, fix, and flip, real estate in the Bay Area. In fact, the private money loan originators, the private money lending industry has really been born in the last 5 years after the subprime meltdown, and it's been the major and primary source of funding for that segment of the industry, because when the subprime meltdown occurred, one of the things that banks did is they pulled back on lending on non-primary residence acquisitions, meaning they're not making loans to real estate investors. So whereas in 2005, if you had a good FICO score, you could fill out a loan application, plug in any numbers you want, and you could buy homes 100% finance. And I know people who did that
in some cases. I remember seeing advertisements you could buy 120%.
Right, absolutely. And so that's not happening anymore. So here we are in 2013, and banks generally are still not making loans to real estate investors. So how do our loan underwriting guidelines differ? Well, a couple of different things. There's really three things that we bring to the party when a real estate investor calls us and says, hey, I've got a property in contract and I'd like to apply for a loan. Number one, usually they need to close quickly because we're in a tight market, and the guy that gets the contract is usually the guy that says, I'll close in 2 weeks. Rare is the closing contract nowadays on a non-primary residence acquisition. Rare is there a contract that goes 30 days. Usually it's 21 days at the most, and it's not uncommon for it to be 2 weeks, maybe even 10 days. Now, banks can't accommodate that quick guideline. No way. So that's one. And then number two is many times the real estate investors do not have the credit scores that the banks are looking for. And in fact, the average credit score I heard, what was it, Robert, the other week was saying, it's now 720 on loans that are closing. I mean, it's pretty darn high. And I have a lot of clients they don't have bad credit, but their credit's in the mid 600s, maybe the high 600s, because they may have had a foreclosure or a short sale.
Or sometimes if they just have a lot of debt,
Or they
even
have
if it's
debt.
investment debt.
Right.
And there's nothing wrong with them.
No,
they never
pay their
pay
bills.
Yeah,
but
exactly.
That's high.
And then number three, the third one would be sometimes the condition of the home is such that the bank, it's not bank financeable, because some of these homes are in a condition that would not pass home inspection with the flying colors that the banks, oftentimes
Like
use.
missing a roof? No, just kidding.
Well, sometimes they're damaged inside. They're missing, right? Even missing a heater. That's simple things like that. It's not bank financeable. So that's part of our underwriting guides. The second part of our underwriting guidelines is that we are not FICO score based. We're not credit score based. So while at Pacific Private Money we do pull credit on every single applicant, bar none, without exception, we don't make the final decision, and generally we don't base the decision on the score, but I do look at the nature of the credit. If their score is hit, and it's hit because they have some unpaid medical bills, or they had some short sales or foreclosures, but all their trade lines have been paid on time, that to me is a good bet. I can back a borrower like that. But if they show signs of laziness, they're not making their monthly payments on a recurring basis, why would I think they're going to make payments on my loan? And so oftentimes we'll decline a loan like that. So again, it's not the score so much as the nature of the credit. And then we also don't have to underwrite their income. That's not required. A lot of real estate investors don't actually have regular income. They make profit on a deal-by-deal basis, and it's not W-2, it's not provable or reliable income from an underwriting standpoint. So the bank, when they need to have verifiable proof of income, they'll look at tax returns, they'll look at W-2s, they'll look at other forms of income, and they'll do all this underwriting and come up with debt-to-income ratios and all this stuff that we don't have to worry about. That
Well,
kind
also
of
the
stuff.
thing is, people, not everybody is very honest on their tax return. So they're going to show probably less income, and it'll be on their tax return and pay very little tax.
Well, as an aside,
Yeah.
I'll just say that I'm not a big fan of an applicant who calls me and if I ask for their tax returns, which I don't always do, but sometimes we will, depending on the situation.
Yeah, you can
And
tell
they-
a lot from the tax
And they
return.
might say something to the effect of, well, I don't show all my
Yeah.
income on my taxes.
Yeah.
And then I have to start thinking about the integrity of the person
Yeah,
that's on
exactly.
the other end of the line. And
Yeah.
so here's the last part, and it's related to what I just said just now, that is, really part of the private lending industry and not so much the bank. When you apply for a bank loan, you are literally a set of numbers. Unless you're going to a community bank and you have a relationship with them, that might be different. But if you go to any of the major banks, you are a collection of numbers. You are your income, your FICO score, your debt-to-income ratio, etc. It's not about the story. But in private lending, if I'm talking to a guy and he starts saying stuff on the phone like, well, I don't report all my income, and I got all this income property, but it's in other names. And, if I start,
or I'm constantly suing my attorney.
if I don't like what I'm hearing, guess what? I'm going to say no.
Yeah.
I don't have to make anybody a loan. We
You
can
can
discriminate.
discriminate. Yeah.
discriminate. Now we don't discriminate based on
Like race or something.
race and sex and all of that stuff. But if we don't feel comfortable with that person, look, we're lending out people's retirement savings. That's the source of capital at Pacific Private Money and other private money loan originators. Our capital is not from banks; it's from private individuals' retirement accounts that people are enjoying 8% yields and higher on their money by funding our mortgage pool fund, which makes loans to real estate investors. And so, I have a fiduciary responsibility to protect that capital. And if I think someone's squirrely, if I don't like the sound of his voice, guess what? Hey, you know what? I can't help you, but I think I may be able to refer you to another company that might. Send me an email. I'll shoot you a couple of referrals, and good luck. So, again, we have the ability to do that in this industry, and I like that. I think that's a good old-fashioned way to do banking. I want to make loans to people who I know have the ability to trust.
That bears out in what is your default rate?
Well, it's next to nothing. I mean,
Yeah.
it's less than the banks. That's for sure. So, and I'm not talking about the hard money industry of old, where every other loan failed. I mean, we're in a completely different business model where we're making conservative, no more than 70% loan to value loans to real estate investors. And
I mean, you're
default rate-
basically making bank loans that banks just don't have the time to make.
and we've had less than 2% default rate on over 600 loans that we've originated since
But
2008.
here's the key
And
question.
no one's ever lost
That's
money.
the thing.
Yep.
Nobody has ever lost money
Yeah.
in those loans.
That's
Right.
what's key.
Okay. So how do people get a hold of you if they want? And what's your fund right now? What's it paying?
So, well, our fund is paying over 8% right now. The third quarter distribution was at an annualized return, a simple interest of 8.9%. And those of my shareholders who are deciding to allow that to compound and not take distributions because they're using their IRAs and to fund to invest in the fund, they're getting a little bit more. So they'll be a little bit over 9%. So. I talked about in the last segment that we had the answer, or at least an answer, an opportunity for people who are frustrated by the low savings rates, the low bond rates, the low rates, being paid pretty much across the board for this type. We've got safety and security features that I think are unmatched in comparison to other traditional investments. So it is an alternative investment strategy, and there are risks, but it's worth looking into. I mean, you owe it to yourself to check us out.
Check it out. Yeah.
Give us a call or check out our website. That's the easiest way to do it. Go to pacificmoneyfund.com. That's our new website for the Pacific Private Money Fund. Go to pacificmoneyfund.com, or you can call us, leave a message, or call us during the week at 415-883-2150. That's 415-883-2150. And we'll send you all kinds of information that you could read at your leisure about how you can make 8% or more on your money secured by Bay Area real estate.
Great. We're going to cut to our third commercial break. When we come back, Lou Batmale is going to give us some advice about recommendations for growth. A lot of people are interested in that. Okay, again, the theme for trivia is the cartoon The Simpsons. What is the name of the guy who runs the Quickie Mart who has been known to say, "Please do not feed peanuts to my God"? That's when someone wanted to feed peanuts to the little elephant that they had on the display there. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190 to answer this question. What is the name of the guy who runs the Quickie Mart in the Simpsons cartoon who has been known to say, "Please do not feed peanuts to my God"? Make sure to include your name, your email address, and speak slowly. Spell out your email one letter at a time. Don't touch that dial. When we come back from commercial break, Lou Batmale will be getting into investments, recommending for growth.
Are we going to 4 or 3?
This is coming into the fourth one.
Yeah, that's right.
Have a fun, Kramer?
Having a ball.
Having a ball. Having a ball.
I'll load it up.
All
Locked
What
and loaded.
growth?
Lots of growth. How's that?
That's growth.
The only growth I seem to be experiencing are skin tags.
I know. I got these look at this age spots. What the hell?
I know, I'm getting those too, age spots.
Jeez.
Don't they have creams for that?
Yeah, actually, I think they do.
I'm gonna start looking at those old guy stuff.
Yeah, really. Lou, don't get older. It's not
I
worth
don't
it.
want to.
It ain't
It's
worth
gross.
it.
Oh well.
See how many minutes? we
Better
got
than
here?
the alternative.
Yeah.
True.
Let's see here.
Who's it? I forget it quick. I can see the guy right now with the
Yeah.
long, dark sideburns. It's
Yeah.
funny.
That's right.
Oh right, yeah, the Indian fellow. Apu.
Is he the one who sells the slushies?
Yes. Quickie Mart.
Mushrooms?
Okay, this would be 9 minutes and 27 seconds.
How much?
9:27, I believe.
Oh, that's a good one. Don't yawn.
You ready, my friend?
Yes.
All right.
Take it away.
Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Onf and Lou Batmale. When we get to the third commercial break, we ask this trivia question regarding the cartoon The Simpsons. What is the name of the guy who runs the Quickie Mart who has been known to say, "Please do not feed peanuts to my God"?
Is that Apu?
Apu. Very
Yes.
good.
Apu for you.
Appropriately Apu. Lou, we got an email from a listener. It says, with the stock market seeming to be somewhat stagnant, what are you recommending for growth?
Can I recommend punting?
Yeah.
Okay.
Is this football? Yes, go ahead.
No, so that's a good question. We've seen in the markets this year, miraculous year by most standards. I mean, you're up in the equity markets, depending on your measurement, over 20% across the board for many of the investments out there. And I think moving forward, there's a positive outlook. I mean, Mark was going into the housing outlook, which is tough, but it's still solid. And for everyone, like I mentioned earlier in the show, look at where you made money this year. Okay, winners always rotate. Okay, that's the theme you want to have in the back of your head right now. Winners always rotate.
Meaning like if bonds is 1 year.
Bonds
then maybe
1 year,
something else.
stocks,
Okay.
large cap stocks versus small cap stocks versus international stocks. It's all, everyone goes, why do I allocate? The allocation idea is you need to really take a look at all the different asset classes. If you don't have those different asset classes inside your portfolio, you won't get 100% of the return of all those asset classes. So when I'm discussing this, the reason why I'm bringing it up is large cap stocks,
Okay.
small cap stocks, mostly domestically, made a lot of money this year.
Yes.
So you guys sit there and think, well, they might do well next year, but they won't do well as some other investment. What's that investment going to be? I'll tell you right now, it's not going to be bonds. I'll give you one example real quick. Okay, this is going to scare you a little bit, so strap in, all right?
I'm sitting
I'm
down.
ready.
Okay,
I
so
even have my headset on. Go ahead.
listen to this stat. Okay, so in 2005, how much money did it take to generate in a 2-year bond market to generate $100,000 of income? Your net investment. You had this balance in your
In
account
2001?
in 2005. 2005, not that long ago, 8 years ago.
Okay.
$2,851,000 yielded you in a 2-year Treasury bond, $100,000. Okay,
Sounds okay.
Not so exciting, really.
not so exciting, but still $100,000, $2 million.
Yeah, but
2.8. Okay,
Right. It's
how
safe.
much would it
20.
take now in a 2-year bond to generate $100,000 of income?
4 million. I'm guessing.
42 million.
I'm close.
Oh
Really?
my God.
I have it here. It's in writing. That makes it right. No, actually, an analyst did that. It's a really great example. This is the 2-year Treasury bond.
Wow.
This isn't the 10-year. This is the 2-year. Remember, these rates are down below a point, right?
Yeah.
Right.
Yeah. What is
So-
what is the yield on a 2-year bond?
I think a 2-year. I think the other day it was like I think 1.07 or I forget. It's fluctuated a lot. I mean, what's a 10-year? 2.8. 10-year is 2.8.
Yeah, but 2-year, if it's 1% for 100,000, well, that would be 10 million.
Right.
Yeah.
Think about that.
Wow.
That's
So-
amazing. The reason I said 2001, I had 2001 on my mind only because I read a stat just recently that if you adjust for inflation, the market
Is that a
as
triple
it,
top?
as it approaches 16,000 is about to equal where it was in
2000,
2001
yes.
at the high.
We're sold at 26 times earnings, and now we're back to 16 times earnings. So we're actually earnings have grown up, but to this overall point is that you're not going to get. Don't take this year and say I'm going to get out of stocks and into bonds. Bonds will provide a yield type return, and those things you're yielding for. Mark touched to earlier. You have to take on a little bit more risk. So you're looking at stuff that's maybe strategic in positioning, like short duration bonds, but those are close to those 2-year treasuries. Then you get into a longer duration bond, and if interest rates change in longer duration bonds that go out 10 years, and you're holding a bond right now, it matures in 10 years, and bond rates go up between now and that 10-year period, you will lose value potentially,
Yeah.
even if you hold it to maturity.
And gold's been getting kind of smoked.
Gold's been kind of getting smoked too, which means there's not a lot of inflation on the horizon. That's why interest rates will stay low for a while.
Yeah.
So I'm saying you don't want to rotate out of stocks into bonds. I think, and what I'm talking to my clients about right now is moving into more international investments, international large cap companies. Remember, Europe is turning around. We've kind of what do they call it? Jump the shark, as they say in Happy Days.
Oh, yeah.
We jumped the shark really in the U.S. markets right now, but overseas, they're still working through a lot of problems. I mean, it wasn't but 2 years ago that Greece was going to go under and sink in the Mediterranean, and so did most of those
Portugal and all that.
most of those Mediterranean states. They call them what do they call those? The resort states
Yes.
of Europe were bringing it down because they overfinanced Portugal and Spain and all those problems. And
Do you like international funds? Or?
I do like international funds. I would say maybe small cap versus large cap in the international space, because when people this year, actually you saw it mid-year in fund flows, people started taking out a Procter and Gamble or stocks over here and started buying the equivalent of those stocks overseas.
Interesting.
And everyone's doing business all over the world now. I mean, emerging markets are another example. And if our currency stays in certain ranges, you'll probably see a big bump in the emerging markets.
How did emerging markets do in 2013?
Not well. Actually
Okay, so-
flat.
Okay,
So that's not a winner.
No, but like I said,
Yeah.
it's a rotating type
It's a
thing.
rotating,
Maybe it's
yeah.
time for them to.
Exactly. And I'm not saying take 40% of your allocation, go to emerging markets. I'm saying trim some of your gains, as I've done for some of my clients, and buy something that's cheap. And you got to look for things that are on sale. And if you don't rotate out of things, you're going to end
So
up
you're
stacking.
not a stick your head in the sand type of guy.
Absolutely not. I mean, a certain amount of this is passive, and I'm not
Yeah.
recommending trading monthly, daily, or weekly. I'm just saying look at your allocation, because this is the end of the year. Everyone goes, I'm going to do that when I have time.
Really, you don't
Look-
like day trading and load funds from one
No, I do
fund
not.
to another?
Not at all. Not at all. And I'll say this, December 26th, I bet you is not going to be busy in everyone's life. Where they're going to be kind of, hey, what should I be doing? We have this is one of those funky calendars. It's a very short season between Thanksgiving and Christmas, and you have those 5 days after New Year's, which is going to be kind of a slow weekend. The 5th is when things really kick off. You look at the way the calendar works this year.
Yeah.
Take that time to sit there and say, hey, look, what's my allocation like in my 401k, in my retirement plan? What do I need to check up on? What's my taxes going to be, this year? What's my income going to be? But more importantly, this allocation thing is you have to do something, because you can lay stagnant for a while, and that won't help you in the long run. If you see a 10% return in one market and a 5% return in the other, where are you going to be happiest? And the answer is, by doing that rotation, hopefully you'll capture that. And asset allocation is a big component. I'm not saying get out of everything and get into something else.
Yeah.
Reallocate. Take your gains somewhere. You get what we call swelling effect, where things get bigger in your portfolio. We'll trim some of that, and put it someplace else that has gotten smaller last year, but not bonds, unless you're strategic.
Okay,
or
well,
high yield.
you got a lot of good information for us. I'm sure there's some listeners out there who would like to call you to get some more information. How do they get a hold of you?
A couple different ways. They can go on to louisbatmale.com, LOUIS, and then BATMALE. They can definitely call 415-256-8970. We can take a look at where you are right now. There's no obligation to do that, of course. And also on my website, they have the email louis.batmale@lpl.com. And love to talk to people, engage in this conversation, because it is a tough time of year, and people are nervous. We've made some money. What should we do now? It's a big conversation piece.
Sure is.
You're right about being nervous. I mean, you just hear listening to you, Lou, that is scary. And again, just kind of going back to the realization of how many people are entering into retirement, and the number of people entering into retirement each year, this year, next year, the following year, is getting larger and larger.
Those baby boomers are booming.
And it's just the worst time to be hitting retirement right now in terms of being able to count on
Passive income.
right? In order to be able to count on earning a sufficient yield that we need so that we can live comfortably in retirement and not end up being in a situation where we're forced to eat Alpo.
Yeah,
Right.
there
I
you
mean,
go.
and yeah, that's right.
All right.
Yeah.
All right, here's our thoughts for the day. Thanks, guys, for
Happy
great
thoughts for this. I
information.
didn't mean to end on a sour note.
That's okay. Here's our thoughts for the
Get
day.
you a
love
coffee
Alpo.
next time.
Okay, ready? I give my right arm to be ambidextrous. I don't know if you thought about that. And my daughter asked if she could see a 50-cent concert. I said, sure, here's $1. Go take a friend. I don't think it kind of works that way, unfortunately. Tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, your host, wishing you the best of investing. So long. All right. That was good. A lot of good information.
And